Imagine waking up tomorrow and the safe crypto asset holding your savings suddenly isn't worth $1 anymore. Not $1, not 99 cents, maybe 70 cents, maybe 30, maybe almost nothing. And before you think, yeah, but stablecoins are supposed to be stable, that's exactly why this conversation matters. Because here's the thing, most people entering crypto think stablecoins are basically digital dollars. Safe, boring, low risk. But history already showed us that when stablecoins fail, they can fail violently. And the scary part, a lot of beginners still don't fully understand how stablecoins actually work, what keeps them stable, and what happens when that stability breaks. So today, we're breaking down what stablecoins really are, why people use them, what depegging means, and whether stablecoins are actually safe in 2026, because honestly, this is one of the most important topics in crypto nobody explains clearly enough. My name is Tito, and I spend way too much time thinking about money systems, investing psychology, and how financial technology is changing the way people store and move wealth. If you're someone who wants to understand crypto without the fake hype, avoid costly financial mistakes, and make smarter decisions with your money, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today we're talking about the crypto assets people think are safe, and why that assumption can sometimes become very dangerous. Section 1. What even is a stablecoin? Let's start simple. A stablecoin is a cryptocurrency designed to stay at a stable value. Usually, 1 asterisk or very close to $1, that's why they're called stable coins. Now you might be thinking, okay Tito, why not just use normal dollars? Great question. Because stablecoins allow people to move digital dollars across crypto networks quickly. And this became massively important for crypto trading, international payments, decentralized finance, online transactions. Countries with unstable currencies in many parts of the world, stablecoins became easier to access than traditional banking. That's huge. In fact, stablecoin transaction volumes have grown massively over recent years as crypto infrastructure expanded. So clearly people trust them, at least to some extent. Section 2. Here's what most people don't realize: not all stablecoins work the same way. This is incredibly important. Because when beginners hear stablecoin, they assume safe, huge mistake. There are actually different types of stablecoins, and some are dramatically riskier than others. Type 1 fiat-backed stablecoins. These are the most common. Examples include USDT, USDC. The idea is simple. For every one stablecoin issued, there's supposed to be roughly $1 worth of reserves backing it. Usually things like cash, treasury bills, short-term government debt. So in theory, you can redeem one stablecoin for $1. This structure is why these stablecoins tend to hold their peg relatively well most of the time. But even here, risk still exists. Because users must trust the reserves actually exist, the company manages them properly, asterisk, and redemption systems continue functioning. That trust matters more than people think. Section 3. The depeg nightmare. Now let's talk about the scary part. What does depeg actually mean? Simple. It means the stablecoin loses its intended value. Instead of $1, maybe it trades at 97 cents, 85 cents, 40 cents, or worse. And when this happens, panic spreads fast. Because stablecoins are deeply connected to the entire crypto ecosystem. Trading, lending, liquidity, payments, everything. So when confidence breaks, people rush for the exits simultaneously. And this is where it gets really interesting. Stablecoins are stable mostly because people believe they're stable. Confidence itself is part of the system. That sounds weird. But honestly, modern banking works similarly. Banks also rely heavily on confidence. If everybody tried withdrawing money simultaneously, traditional banks would struggle too. That's why bank runs happen. And stablecoin depegs often behave psychologically like digital bank runs. Section 4. The stablecoin collapse that shocked crypto. Now, if you've been in crypto for a while, you probably remember Terra Luna. And honestly, this event terrified people. because it showed what can happen when a stablecoin mechanism breaks completely. The USD stablecoin was supposed to maintain its $1 peg algorithmically, meaning it relied heavily on market incentives and system design rather than traditional reserves. And for a while it worked. Until it didn't. When confidence collapsed, USD rapidly lost its peg, wiping out billions in market value and causing widespread panic across crypto markets. People lost savings, life-changing money, entire portfolios. Some investors genuinely thought stable meant safe. That misunderstanding became catastrophic. This is the big lesson: stability mechanisms matter a lot, and beginners often don't investigate them deeply enough. Section 5. Now you might be thinking, okay Tito, so are all stablecoins dangerous? Not exactly. But they're definitely not risk-free. And this is where nuance matters. Because there's a huge difference between short-term parking of funds and treating stablecoins like a guaranteed savings account forever. Those are not the same thing. For example, many fiat-backed stablecoins hold large amounts of short-term U.S. Treasury assets, which are generally considered lower risk relative to many crypto-native systems. That improves stability. But no system becomes magically riskless. There's always counterparty risk, regulatory risk, liquidity risk, operational risk, market panic risk. The question isn't, is it perfectly safe? The question is, how much risk exists compared to alternatives? That's a more intelligent way to think financially. Section 6. Why stablecoins became so important despite the risks. Stablecoins solved real problems, especially globally. Imagine living somewhere with high inflation, weak banking systems, currency instability, capital controls for millions of people. Stablecoins became easier to access than U.S. banking. That's powerful. And honestly, this is one reason stablecoins probably aren't disappearing anytime soon. They provide utility. Real utility. Not just speculation. And historically, technologies solving real problems tend to survive longer term. Section 7. The psychology of safe. Here is what fascinates me most. Humans love the idea of safe money, but financial systems are rarely completely safe. Even traditional systems carry risk. Banks fail. Currencies inflate. Governments make mistakes. Markets panic. The difference is, people are used to traditional financial risks. Crypto risks still feel newer emotionally. And beginners often make one huge mistake. They assume stable means guaranteed. That's dangerous thinking anywhere in finance. Section 8. What I personally think matters most. Honestly, the biggest thing isn't blindly trusting or blindly fearing stablecoins. It's understanding how they work, what backs them, where risks exist, and what role they should play, because informed users make better decisions than emotional users. And this applies to all investing, not just crypto. Here's what most people don't realize: complex systems often appear safest right before stress tests happen. That's true in banking, markets, economies, crypto. Everything looks stable until pressure hits the system. That's why risk management matters so much. Section 9. What I tell beginners if you're newer to crypto. Here's my honest advice. 1. Don't assume stable means risk-free. Very important. Lower volatility does not equal zero risk. 2. Understand what backs the stablecoin. Research matters. Ask, is it reserve-backed? Audited? Transparent? Widely adopted? 3. Diversify risk. Putting everything into one platform or one asset creates vulnerability. 4. Stay calm during panic. Most financial mistakes happen emotionally during chaos. 5. Learn before trusting. This alone prevents so many disasters. Conclusion. So are stablecoins actually safe? Sometimes relatively safer, but never perfectly safe. And what happens when they depeg? Usually, panic, fear, liquidity problems, and a brutal reminder that financial systems depend heavily on confidence. The good news: most stablecoin failures teach valuable lessons that improve future systems. The bad news: many people only learn about these risks after losing money. And honestly, That's why understanding the system matters more than blindly following hype. Because in finance, the people who survive long-term usually are the people chasing excitement. They're the people who understand risk better than everyone else. If this video helped you understand stablecoins more clearly, hit the like button, subscribe, and let me know in the comments. Do you trust stablecoins? Or do they still feel risky to you?